Meet Daniel and Marcus. They are both 25 years old, they both have full-time jobs, and they each earn $60,000 a year. After paying taxes and covering their living expenses, they both manage to save about $10,000 every year. Neither of them is wealthy, neither has a trust fund, and neither has discovered some secret investment strategy that Wall Street doesn't want you to know. However, they do have one important thing, a decision that will shape their financial future. Daniel believes the safest path is to save every dollar, while Marcus believes that saving is only the first step toward building wealth. So they make a simple agreement. For the next 20 years, they will both put $10,000 a year toward their future. Daniel will keep his money in a high-yield savings account, while Marcus will invest his money in a diversified stock market index fund. They start with the same income, the same savings rate, and the same opportunities, yet they choose completely different strategies. The question is, what happens after 20 years? During the first year, Daniel follows a simple routine. Every month he transfers about $833 into his savings account, and because his money is protected, he never worries about market headlines. If stocks crash, he doesn't lose sleep, and if stocks surge, he doesn't feel left behind because he values certainty above everything else. Meanwhile, Marcus also invests about $833 every month, but unlike Daniel, he watches his account move up and down. Even so, he never stops investing because he understands that short-term volatility is part of long-term investing. By the end of the first year, both have contributed roughly $10,000. Daniel's savings account has grown to about $10,400, assuming a 4% annual return, while Marcus's investment account is worth around $10,500, assuming an illustrative 7% annual return. At this point, the difference is almost invisible, and Daniel quietly thinks his strategy has been proven right. To be fair, after just 1 year, he has a good argument. 3 years later, Daniel has contributed about $30,000, and thanks to steady interest, his savings account has grown to approximately $31,900. Marcus has also contributed about $30,000, but his investment account has reached roughly $34,800. Although he is ahead by only about $2,900, many people would look at that gap and wonder whether investing is really worth the risk. The truth is that compounding is incredibly slow in the beginning during the early years. Most of your account balance comes from your own contributions. However, those early years are quietly laying the foundation for much larger gains later. By the 5th year, Daniel has deposited approximately $50,000, and his savings account has grown to around $54,000. Marcus has contributed the exact same amount. Yet his investment portfolio is now worth about $59,000, even though Marcus is ahead by roughly $5,000. Daniel still feels more comfortable because he has never experienced the emotional roller coaster of a market crash. Marcus, on the other hand, has already watched his portfolio fall from nearly $60,000 to almost $50,000 before eventually recovering. While Daniel's balance only moved upward, Marcus had to remain calm while seeing thousands of dollars temporarily disappear. This is where investing becomes more of a psychological challenge than a mathematical one. Your emotions often tell you to stop investing precisely when history suggests you should keep going. 7 years into their journey, Daniel continues making automatic deposits without changing his routine. He has personally saved about $70,000, and his account is now worth roughly $81,000. Marcus has contributed the same amount, but his portfolio has grown to around $86,000. Although the difference is still relatively small, something important has changed. Marcus' investments are now producing meaningful growth on their own. In other words, his money is beginning to generate additional money without requiring extra effort from him. Daniel also earns interest, but because his expected return is lower, his financial snowball grows much more slowly. By year 10, both men have contributed approximately $100,000. Daniel's savings account has reached around $120,000, which is an impressive milestone by any standard. Marcus, however, has seen his investment portfolio grow to approximately $138,000 under the same assumptions. The gap has widened to about $18,000, even though neither man received a promotion. Inherited Monayer started a successful business. The only difference is where they chose to keep their savings. More importantly, the next 10 years may become even more powerful because Marcus is now earning investment returns on a much larger balance. 2 years later, Daniel's savings account reaches approximately $147,000, while Marcus's portfolio grows to around $172,000. At this point, Marcus is ahead by roughly $25,000. That doesn't mean Daniel has made a mistake because saving money remains one of the most important parts of personal finance. His emergency fund provides safety, flexibility, and immediate access to cash whenever unexpected expenses appear. However, inflation quietly reduces the purchasing power of money over time, which means that although Daniel's account balance continues to increase, the amount of goods and services that money can buy doesn't necessarily grow at the same pace. After 15 years, Daniel has contributed around $150,000, and his savings account has grown to roughly $200,000. Marcus has contributed exactly the same amount, but his investment portfolio is now worth approximately $251,000. The difference has expanded to more than $50,000, not because Marcus found a miracle investment, but because he simply gave compound growth enough time to work. Compounding doesn't reward excitement or intelligence nearly as much as it rewards patience. By year 17, Daniel's account has reached roughly $238,000, while Marcus's portfolio approaches $300,000. Now the difference exceeds $60,000, and Daniel naturally wonders whether he should have started investing earlier. At the same time, he remembers every market correction Marcus had to endure along the way. Daniel never experienced those temporary losses because a savings account provides stability, whereas investing offers greater long-term growth potential at the cost of short-term uncertainty. Neither approach is inherently right or wrong because they are designed for different purposes. Finally, year 20 arrives. Daniel and Marcus are now 45 years old, and both have contributed approximately $200,000 over the previous 2 decades. Daniel checks his savings account and finds nearly $297,000, assuming a 4% annual return. That's an outstanding financial accomplishment and proof of consistent discipline. Marcus then checks his investment account, and under our illustrative 7% annual return, it has grown to approximately $410,000. That's about $113,000 more than Daniel, even though both men invested the exact same amount from their own pockets. The difference didn't come from earning a higher salary or working longer hours. Instead, it came from allowing investment returns to compound over many years. Before concluding that investing is always better, it's important to remember that these figures are only illustrations. The stock market does not produce the same return every year, and there are periods when portfolios can lose significant value before recovering. Likewise, savings account interest rates change over time. In reality, most financially successful people don't choose one extreme or the other. Instead, they keep enough cash in savings for emergencies while investing money they won't need for many years. Ultimately, Daniel's greatest strength was discipline, while Marcus's greatest strength was patience. Daniel protected his money, whereas Marcus allowed his money to work for him. Daniel prioritized certainty, while Marcus accepted temporary volatility in exchange for higher long-term growth potential. Neither man failed because both built substantial wealth through consistency. The real lesson is that financial success rarely comes from finding one magical investment. Instead, it comes from saving regularly, investing wisely, and giving ordinary amounts of money enough time to grow into something extraordinary.